Hi, everyone. Welcome to today's virtual event. I'm Kat Delgadillo here to host our Family Office Roundtable. Unfortunately, Hall Martin couldn't be here to join us, but that's okay. We're just going to go right into it and talk a little bit about what we do here at 10 Capital Network.
Hello, this is Hall Martin with 10 Capital. We're here today for our next event. And before we jump into it, I'd like to talk more about what 10 Capital does. We help startups and investors connect for funding. And what we do is we help form capital for the early stage entrepreneur ecosystem. For those companies that are raising funding, we help them put together their pitch deck, advise on their fundraise program, help with their strategy, and then make introductions to investors. In short, we provide the legwork, saving you time and money. We've been doing this since 2009 when we originally called Texas Entrepreneurs Network, and we've raised over $900 million of funding for our companies. We also help form capital for the early stage. We help high net worth individuals launch family offices. There's many people that in the $25 to $50 million assets under management space that want to launch family offices, and we have a program with our Family Office Roundtable to do that. We also help VCs find limited partners, mostly family offices. We do monthly dinner events, bringing VCs and family offices together. And then we help angel groups find members. This is a great way for helping individual angels be more successful because they get to share the deal flow and the due diligence with an angel group. We have 4 events that we do online each month. We have a Family Office Roundtable. It's a 2-hour session with topics relevant to those who want to start and run a family office. It's focused primarily after the virtual family office, so we do a lot of discussion about how you set those up. We also run a quick pitch. This is for tech companies. Each company gets 10 minutes to pitch, 5 minutes of Q&A, and we have 4 to 5 companies presenting with breakout rooms afterwards, and a panel of investors asking questions, and also investors in the audience. And finally, we have the Life Science Syndicate event, which is a monthly meetup where we bring those on the FDA path together to also have a panel of investors and have pitching. And if you want to learn more about our events, just go to 10capital.group, click on the events button, and you'll find out more about us there. If you're a startup and you want to raise funding, just click a picture of that QR code, fill it out, send it to us, and we'll follow up with you to see if our program would be a good fit for your fundraise. We also have our AI chatbot, Ava. Ava is a automated solution that helps people get answers to their questions about startup funding and investing. This comes from our Investor Connect program. We have over 800 interviews with investors, angel, VC, family offices on what they invest and how they invest and what they look for in startups. And we also have a Startup Funding Espresso. The time it takes to drink an espresso, you can learn something about startup funding and investing. And so with that, we've actually built over 2,000 of them. These are 300-word microblog posts, minute-and-a-half audio component, and we put them all in a chat bot. So all you have to do is ask your question, and it gives you the answer. We call it Ava. So let's listen to learn more about that.
Hi there. I'd like to introduce myself. My name is Ava, your personal AI venture assistant. I'm your new best friend in the world of investing in startups, the 10 Capital AI chatbot. I'm here to make your journey through the startup ecosystem easier, faster, and a lot more fun. Need help finding your next big investment? Or maybe you're a founder looking for fundraising tips? I've got you covered. I pull all my knowledge from over 500 blogs, countless podcasts, and even some nifty calculators, like the How Fundable Is Your Startup tool, to give you the answers you need. So how do I work? Easy. You simply go to where I live on startupfundingespresso.com and look for me in the bottom right. As soon as I appear, go ahead and click on me to let me know you're here. And then there you go. All your questions answered at your fingertips. Whether you're into health tech, biotech, life sciences, or any of the other exciting fields out there, I'm equipped to help you navigate the trends, challenges, and opportunities in each one. Got a question? Just ask. And guess what? I even pull insights from the 10 Capital Network podcast on Investor Connect. It's packed with expert advice, success stories, and more, all designed to help you succeed in the venture capital world. So what are you waiting for? Let's chat. I'm here 24/7 to help you find the right answers, connect with great opportunities, and make the most out of your investments. See you on startupfundingespresso.com.
All right, we can go ahead and introduce our guest speaker today. Ron, do you want to go ahead and tell us a little bit about South Highland Ventures?
Yeah, sure. No, thank you so much. And first, I'd like to thank 10 Capital for giving South Highland Ventures this opportunity. They're a fantastic partner, and I believe everybody should be looking towards them for leadership when it comes to companies, investors, and growth. What we do is we are a one-stop shop private equity firm where we invest family office and high net worth individual capital into growth companies and opportunities, in particular, investing in companies that are struggling with succession. We're located here in San Antonio, and we have offices in several states, and we have operations all around the world. And look forward to learning more about you, and thanks for having us.
Sorry, I was muted there. With that being said, thank you, Ron. We can go ahead and jump right into the pitches, Lance, if you want to go ahead and share your screen and start.
Yes, ma'am. Thank
Great.
you. Hi, I'm Lance Throkill, co-founder of PRINT3D Technologies. As you can see, America has a real problem. We are short 7.3 million affordable homes, and we're only building 1.4 million homes per year, of which less than 10% are focused on affordability. Construction costs are up 30% in just 5 years, and the industry is stuck in the past, and people are struggling to find a place affordable to live. At PRINT3D Technologies, we are solving this problem by disrupting the construction industry. We're doing that by bringing automation, AI, and 3D printing to construction to make it more affordable, sustainable, and scalable. But before I tell you how we can do that, let me tell you how we got here today. Having built several homes myself, I've seen firsthand the inefficiencies in the home construction business. And a few years ago, my family unexpectedly lost their home to mold, or our home to mold. And building the next house took twice as long and went 50% over budget. And at that time, I knew there had to be a better way. To make matters worse, if it's this inefficient and expensive for me, how much more impactful is that to somebody who's struggling to afford a house in the first place? The reality is the system is broken. And when there is a broken system, there's an opportunity for innovation. That's why we built PRINT3D Technologies, to solve a real market failure. Here's my co-founding partner, Craig Pettit, and myself outside of one of our 3D printed homes. My family has been invested with Craig in his residential real estate portfolio for over 30 years. And in 2019, he bought a 3D printer and successfully printed the 7th and 8th 3D printed houses in America. As a third-generation owner of a manufacturing company that's highly focused on automation, I became fascinated with this concept. Through my experiences in home building, the inefficiencies were shocking to me. Coming from manufacturing, where efficiency and precision are everything, the lack of these principles in construction were just shocking to me. That frustration sparked an idea. What if we could apply a manufacturing mindset with automation, robotics, and AI to home construction to transform the home construction industry? I shared my vision with Craig, and he immediately saw the potential. We had the perfect combination of expertise, his real estate background and my manufacturing expertise, to tackle one of the world's largest problems, affordable housing. 2023, we made our move. My company, All Metals Fabricating, invested $750,000 to match what Craig had put in up to that point, and we launched PRINT3D Technologies. Our mission is simple: revolutionize construction to make it more affordable, efficient, and sustainable. We're not just building homes, we're manufacturing and selling the machines to help builders everywhere embrace this new technology. So let's understand the opportunity. For over a century, American homes have been built the same way: wood framing and labor-intensive construction. It worked. It's fueled the economy. It created communities to support growing families, and was the American dream. But sadly, that dream has slipped away due to rising costs driven by skilled labor shortage and material costs, and compounded by the industry's slow adoption to new technologies. As you can see here on the graph, rents have been rising much faster than incomes for decades. Average home prices are up more than 100% since 2000, while wages simply haven't kept up. Construction costs are up over 30% in the last 5 years, not including increases we're seeing now from the tariffs. The industry has been forced to use less skilled workers and inferior materials to lower costs, leading to a decline in the quality of housing. In just 10 years, the amount of people being able to afford a home has gone from 50% to 16%. This is a massive issue. And we have a solution. Has anyone seen a 3D printer? Probably the size of a desktop. Well, now scale that up to the size of a house. And that's what you have here, our patented 3D home printing machine. It works like a self-serve ice cream in the sense that it comes out the nozzle like that, except that it's concrete coming out. And geometric code, later referred to as G code, tells the machine where to go and what to print. So what differences does our solution provide? First off, we can provide a 20% savings for a wall system that far outperforms traditional building methods. Our houses are mold resistant, termite resistant, fire resistant, and hurricane and tornado resistant. And that's especially relevant recently. You look at California, there was one house left standing in Malibu. It was a concrete house. Same thing happened in Hawaii several years ago. There was only one house left standing and it was concrete. Granted, they were not 3D printed, but it's the same materials. So you can see the potential and the rigidity of these houses. Next, we can provide a 30% time savings versus standard construction methods. Time is money. And with our wall systems, we're removing framing, sheetrock, tape bed and texture, paint, and masonry, as well as insulation because of the thermal properties of the walls. So you don't have to have insulation as well. Next, precision construction practices reduce waste significantly. The combination of proper and precise planning while also using recycled materials and the long-term durability of our concrete will reduce landfills significantly over time. Lastly, 3D concrete housing reduces ownership costs. Our walls are more energy efficient, lowering bills. Also, the house is much more durable. So what's our competitive advantage? Starts with our partnership with All Metals Fabricating, which I own, is a world-class manufacturing facility shown here in the picture. This vertical integration gives us full control over production, cutting costs, and engineering on the printers we sell, demonstrated by the fact that our current model costs us $175,000. The most comparable one on the market is $1 million. Equally as important, through this partnership, we can scale up production to meet any amount of demand that there can be for 3D home printers. So All Metals has the capacity to crank out hundreds of these in a month, no problem. Next, combining our real estate experience along with data-driven insights and approach will allow us to streamline home construction nationwide. PRINT3D has also inherited an expertise and efficiency and automation through our partnership with All Metals Fabricating, which we are bringing to construction. So what have we accomplished so far? In 2019, we commenced business. 2021, we built the seventh and eighth house in America. Since then, we've built 5 structures, including a house for $100,000 last year. We redesigned and built 2 of our second generation machines. We've achieved a top 10 worldwide rating for automate construction and a top 5 for 3D home printing. We developed an augmented reality app that allows people to plant any one of our model homes on coordinates and walk through that house, turn the house to meet whatever direction the sun's coming up, which position the house however they like it. We look to further develop this technology to train builders to use the machine, as well as trades for electrical and plumbing and such. We also completed a rebranding and launched a marketing campaign last fall. This year, we received our patents back on our design. We've developed $2.5 million in the sales pipeline as of just December when we started the sales pipeline. We've also invested $1.5 million to date, and recently, just this past month, we won 3D Printing Company of the Year by Construction Tech Review magazine. With all that said, all that we've accomplished, we feel very confident in raising a $1 million at a discounted rate of $8 million valuation, and then a second tranche at $2 million at a $15 million valuation to achieve the following. First, develop a proprietary software that will take a rendering, whether it be 2D or 3D from Architect, and generate the G code to control the machine. This will allow us to scale up quickly allow builders to take any plans and input them into the software, and it automatically create the G code to run the machine, as well as give them a cost calculation to bid on the job. And equally as important, this creates a SaaS revenue stream for us as a technology company. Next, we will be investing in the third generation of our machine to develop a brick style print head, which will allow us to appeal to traditional architecture styles as opposed to the bead look now. It'll also allow us to more efficiently achieve a smooth wall finish, which is something that we're hearing a lot of customers want. We also will be developing a mini concrete mixing batch plant to go with the machine, which will greatly reduce the cost of materials for each job. Next, we're going to hire a dedicated R&D team to support ongoing innovation so that R&D is not slowed by our construction jobs, which we feel is critical as a technology company. Lastly, we will build additional machines to be able to take on large-scale development projects and have sufficient stock for sales. So here's some very conservative numbers. I honestly believe that the 2025 number is the most difficult one to achieve, just given the amount of time we're spending on fundraising, but 9 structures. So these revenue numbers are based on structures printed and machines sold. So 2025 would be 9 and 2, 2026, 40 and 8, 2027, 75 and 24, and 2028 would be 125 structures and 48 machines. Now, we'll mention the market adoption by builders could exponentially increase this growth curve. And as I mentioned earlier, All Metals Fabricating would have no problem keeping up with the capacity. We'd have no limitations in producing as many units as the market could demand. And we plan on selling our machines for $400,000 with a cost basis of $175,000. And as I mentioned earlier, the most comparable option starts out around $1 million. So for example, in 2028, if we sold 100 machines instead of 48, that would boost our revenue by $20 million alone and boost profitability substantially as well. So I want you to imagine this with me. I want you to imagine an entire community being built by 3D printers, 20, 30 printers out there, all printing at the same time, 2 people operating a machine. And what we call a house in a box showing up for every house, where it has everything you need for that house: doors, windows, appliances, HVAC, everything you need so the trades can get in and out. Then I want you to imagine a family like this moving in happily after just 3 months at an affordable price. And with this type of solution, we can change the trajectories of affordable housing. This is more than an investment. It's an opportunity to fix a broken system and transform the future of housing and construction. We have the technology, the expertise, and the urgency to make home ownership more accessible while building a high-growth, scalable business. The need is massive, and the time is now. Join us. Thank you.
Awesome. Thank you, Lance. Ron, do you have any questions for Lance? And if you have any questions out in the audience, please feel free to drop them in our webinar chat.
Hey, Lance, great presentation. I was
Thank you.
hoping you're welcome. I was hoping if you can expand a little bit more on the relationship between PRINT3D Technologies and Almost Manufacturing. Is that the name of your
Yes, sir. All Metals. Yes, sir. Yeah. So
thank you.
absolutely. Yes. All Metals is a 50% equity holder in PRINT3D Technologies. And so we're 50-50 with my co-founding partner, Craig Pettit. Does that answer your question? So
Yeah,
we did the design and built the Gen 2 machine.
Okay. And how is that relationship with PRINT3D? How are you sharing technology and resources and things of that nature?
So essentially, we have in-house engineering and manufacturing. And so given our partnership and our equity in that, I mean, PRINT3D is still paying for the manufacturing and the design at a discounted rate for the design aspects of it. But basically is what it gives is, you know, when you're a startup, getting into a contract manufacturer, getting their attention, being able to push product through is a great challenge. Plus you're going to pay, you know, much higher prices. Because you're a startup, they're going to build in a lot of extra costs for them to take on a small job like that. So being able to have, you know, a manufacturing company that can scale up with you quickly as needed, and that company has equity in the business, it's essentially a vertical integration.
Okay, thank you very much.
Awesome.
Yes, sir.
And we do have a question from the audience. Pedro asked, if your closet competitor charges more than 1 million, why are you pricing at just 400K? Also, what is your minimum check size?
So minimum investment size, we've said 50,000. we would be open to 25, but 50 is kind of where we've set the threshold. It's a great question. We want to have a price that is grabs people's attention. Our machine is also a much simpler approach, and so we kind of want it to be I call it like the every builder's printer, where you're able to onboard much quicker. There are some options available that are close in the 500,000 range. They're just not being used yet. So I want to be transparent about that. They're kind of no name brands that are, have been around and just nobody's really adopted them yet. So when I say the best available option, it's not the only available option. It's just the best one that's available and comparable to our gantry style. But there's certainly room to go up. Yes, I agree with that. And we're not opposed to it.
Awesome. It seems like we're out of time, Lance. Thanks so much for your presentation.
Thank you.
Next up, we have Mike from GridMatrix. Mike, if you want to go ahead and share your screen, we can jump right into your pitch.
Hi, everyone. I'm Mike Green. I'm the co-founder and COO of GridMatrix. We're building a new way to approach infrastructure, AI, for large cities, ports, and airports. We were founded 4 years ago. We are now post-revenue. We're raising an additional $1 million on an existing priced round that was led by 8VC. It's a $9.2 million pre-money valuation. We're filling out last $1 million. Company overview. So we optimize critical infrastructure. So kind of the current way that cities and port operators operate is they essentially use best practices from civil engineering firms and from kind of aggregated anecdotal knowledge that's accumulated over the last 50 years. What we're doing is allowing these operators to turn their sensors, especially their cameras, into data sets that can actually be used to make data-driven decisions. So we're kind of moving infrastructure into the 21st century. So specifically what we do is we stream sensor data into the cloud and use computer vision to convert it into a data set that shows an understanding of the 3D world around them. So cars, pedestrians, cargo, ships moving through space. So we're cloud-based and scalable. We already have 9 current customers, including one of the world's largest ports, Port Authority of New York, New Jersey. 2024, we had $550K in revenue. The market that we're playing into, as I mentioned, is about $1 trillion civil engineering market. And we're located in Austin, Texas. What's the problem that we're actually solving? Governments have data and need data and already have a lot of sensors that are dumb sensors that are just sitting there passively monitoring what's going on. So think a camera that just passively monitors an intersection or what's happening in a port. But they have a ton of questions about what's happening in their infrastructure. The airport operator wants to know, how often are cars actually sitting on my curb for more than 5 minutes, requiring me to send someone to move them? Port operator wants to know, I want an alert for when a vessel docks and when it leaves, so that I can cycle through the ports and maximize my occupancy. The city transportation manager wants to know, what are my top 5 most dangerous intersections and what can I do to ameliorate that? So the solution, we make existing sensors smart. So as opposed to our competitors who sell new hardware, we plug into existing cameras and sensors. So we're hardware agnostic. We can turn this data into actionable insights and KPIs across 4 key categories, including safety, emissions, idling time. We're built for infrastructure. We deliver live data and historical data on facility operations. We're built for operators of large, complex infrastructure. So to go into exactly how this works, because I know I'm saying a lot of high-level things, when we engage with a customer, we essentially receive IP addresses that connect to their existing cameras, and we stream those that sensor data, the video streams into the cloud. We process it in the cloud, use computer vision and AI, convert that into a physical data set that just shows objects moving through space. And then we serve that data set back to them, both via an API and a dashboard. We like to show this slide to talk about how essentially the value of our product scales over time. The value of our data set increases the more sensors and the larger number of customers we have. We can use the data set to drive actionable insights, which provides value to the customers. They then want to plug us into more sensors, builds our data set, and which drives more ROI. Here's an existing customer use case. We're now plugged in at Dallas-Fort Worth Airport, one of the largest airports in the country. They're using us on the roadside of the airport to analyze their curb use, analyze traffic patterns, understand, especially even when certain parts of their parking lots are being heavily utilized. They want to reduce emissions, and they want to have alerts and notifications when certain events occur. On the air side, so facing the inside of the airport, managing their fleet vehicles, cargo visibility, and security and threat detection. This is our engagement at the Port Authority of New York and New Jersey. We're optimizing their container port, similar uses, but mitigating truck queuing, optimizing loading and unloading times, reducing emissions, sending alerts and notifications, and like DFW, managing fleet vehicles. As I mentioned, we already have 9 paying customers, some very notable logos that give us a lot of presence in the space. It's a copycat space, so if you have larger, reputable customers, it's easy to sell into new customers. We achieved about 580K of bookings and gross AR in ARR last year, and intend to hit about 1.5 to 2 million this year. Our contract size scales as deployments go on, so our average contract size will increase to 300 or 400K this year. It tends to be a crawl, walk, run model, where you do an initial POC and then a larger engagement with, say, 10 to 50 sensors, and from there you can grow to multi-million-dollar size contracts. Can share this presentation later, but we have a large qualified pipeline. A lot of this occurs in RFP submissions that we are currently awaiting the result of, as well as renewing and upscaling our current customers, especially the Port Authority, which should occur next quarter. A proxy for understanding how large this market is to understand the number of projects that get submitted that require this kind of software, hardware agnostic AI software for transportation. Since we founded that, the number of projects that get put out for proposals has probably doubled or tripled every year. I think in our first year, there was probably a handful. And this year, it looks like there's going to be a few hundred. So it's good timing. Clearly, the market's growing. As I mentioned, our TAM, we're competing with large civil engineering firms who also probably will represent likely acquirers of our company, big public players in the space such as Jacobs, AECOM, and Parsons. This is our founding team, and actually our CEO, Nick, just joined, so he can probably participate in the Q&A. But he came from Apple, where he managed their global supply chain for the 5G product. Before that, he came from McKinsey and Yale Business School. Myself, I've been working for startups for 10 plus years. And before that, I was a quantitative analyst. And our head of engineering, Eric Valasek, came from NATO, which produces OEM or camera vision for OEM car companies such as Mercedes-Benz. Getting to the round dynamics, as I mentioned, it's a $9.2 million pre-money valuation. We've closed 2.2 million, and we're looking to fill out another 1 million to get us to 3.3 total It was led and underwritten by our large inside investor, AVC, and its partner, Alex Moore, who joined the board as part of the round. He's also on the board of Palantir. We see a lot of similarities between ourselves and Palantir as we're seeking to disrupt a large incumbent consultant market. And I'll stop there and pause for questions.
Awesome. Thanks for that presentation on GridMatrix. If we have any questions from the audience, please feel free to drop them in the chat. Ron, do you have a question for Mike or Nicholas?
Yeah, again, great presentation and looks pretty novel. I was hoping if you can go into a little bit more on the sales cycle, right? Because whenever you're pitching to basically municipalities and quasi-government organizations, it can take quite some time. And so I was just curious to understand a little bit more about how long it takes to get through the crawl, walk, run kind of stages, and also how sticky have the trials been? If you had anybody peel off as you've been going through the software adoption process.
I can take that. First of all, can everyone hear me? Because this is the first time that I've tried to speak in here.
Yes.
Great. Okay, so the point of the sticky flywheel slide is that we've actually never churned a customer. We have a 100% retention rate. The flip side of that is that it is hard to catch the tiger by the tail here. Government customers do have a long sales cycle. For a brand new logo, probably anywhere from 9 to 12 months, really to get up and running with them. But at the same time, once you do get them, you know, they don't switch, and our renewal sales cycle is like 3 months or less. You know, as we come up on like the end of a deployment, upselling, renewing, that entire process usually takes about 3 months. Did I answer your question, Ron?
Yeah, thank you.
Great.
Awesome. Ron, do you have any other questions? Anyone from the audience? Okay, it looks like we don't have any other additional questions. Thank you for your presentation, GridMatrix. I will be sending over any information that we pull from today to you guys. Now we can go into Ron's presentation.
Cool. Thank you, everyone. We'll get out of here.
Thank you.
Oh, thanks. So you just want me to share my screen?
Yeah, so now we have Ron, who's going to be doing a presentation on the best performing asset class in the world.
Can everybody see the screen and hear me, see me fine?
We can. Yeah, we sure can.
Okay, great. Well, thank you so much for being here today. Again, I want to thank the other companies for their presentations and also for 10 Capital Network. And they've been such a great partner and doing a lot of very good things for venture backed companies and also for emerging managers such as ourselves at South Highland Ventures. So,
sorry to interrupt. Before you go in, I'm not sure if you're in presentation mode or I can see your next slide. I'm not sure if that matters to you. If not, then continue, but just wanted to give you a heads up.
Okay, yeah, that wasn't supposed to happen. So
totally fine. Yeah, maybe if you go to the display settings right beside it.
Is that better?
We're still seeing the same thing, but if you try to go to the display settings on the
it didn't do this when we practiced it, I promise everybody.
Yeah, it did. But that's totally okay. We can do this again. Yeah, just go ahead and share it again.
What, share my screen?
Share your presentation, go into presentation mode, and then go into display settings right at the top corner.
What should I click on here?
Yes, I would try that.
Click here.
There we go. That looks great.
Okay, thank you. I learned something new today. Thank you. So, okay, everybody. Search funds, the best performing asset class in the world. It sounds a little dramatic, but it really is the case. And so it's a confluence of several things that are happening in the marketplace. But really, it's a $10 trillion market opportunity that is it's a real opportunity, but there's a real solution for the succession challenge that we're having around the world, and that is a search fund. It's a 40-year-old model that came out of Stanford and Harvard, and it's becoming more and more interesting and prevalent because the market opportunity and the need for it is more than ever before. But first, a little bit more about South Highland Ventures. Again, we're a full service private equity firm managing direct investments for family offices. And these are some of the things that you may be familiar with. Some of these logos, PosiGen, it's a very innovative residential solar company that EBITDA has grown 13 times since our initial investment in 2018, and company is worth over $1 billion right now. Also with RES, it's another company that grew from zero to nearly 100 million in EBITDA right now. And so at South Highland Ventures, we're very familiar with company growth and what it takes to understand all the transitions that companies go through from startup, from idea, all the way through to mid-market and even public markets. South Highland Ventures, we believe entrepreneurs are the superheroes of our time, and we have a balance of experience as investors, but also operators and advisors. Have over 20 years of being a part of the growth and exit process with companies, again, from initial idea all the way through to low mid-market and public market exits. Have over 100 transactions under our belt with over 900 million of assets under management, not counting the family offices that we've worked with from time to time, making direct investments. And one of the unique perspectives that we have is engineers with business backgrounds. And in particular with this opportunity with search funds, my reason for doing this is my grandfather had a business, as you can see here, had our own service business that he lost due to succession. He had a couple dozen employees and actually worked for Richard Petty in his heyday. And my father was on the pit crew back in the 70s. And so he was very good at what he did and he loved it, but my dad wasn't interested in the business and he regretted it to the day he died. And so it's really what has pushed me to get an MBA and to serve others and to serve other companies and investors that are getting into this asset space. Some of the recent activities for South Highland Ventures, it was obviously working with Novastone Capital Advisors, which is a preeminent search fund advisory group, and I'll talk more about that. They've deployed over 200 million in their search fund program, but also some familiar logos. We're based in San Antonio and have been working with angel investments and also university-based technologies throughout the last 5 or so years. So the problem, it's a very big problem, over $10 trillion worth in the United States and then Europe alone. And these are companies where you have people that have founded a company and have grown it to a point, but they don't have anybody to pick up the business, right? These are companies that are doing, basically 250K in EBITDA upwards to 15 million in EBITDA. And they're stable companies with very strong profit margins, but they just don't have the access to capital and talent to scale the business and also to feel confident to hand the baton over to them so that they can pick up the business and grow it. And it's estimated that over 5 million companies are in the US and the EU alone. So it's a massive, massive problem that just keeps getting larger and larger. So what does that actually translate into? It's $1 trillion a year, 2,700 companies per day, which leads to $2.7 billion worth of value every day of companies that are closing their doors because they don't have a real solution that is available to them to allow the business to continue. But it's also an opportunity for us. And this really rolls into what the search fund has done and what it can do. And so some people are more familiar with search than others, but basically it's a hybrid of an LBO acquisition model, LBO meaning leveraged buyout in private equity. And so this was created in the mid-1980s through Stanford and Harvard, specifically tailored to find a greenish, 20-ish old entrepreneur that has talent, but they don't have the capital or the experience, but they're coachable. And so the idea was to back them, give them some money so they don't get a job, but to back them and to have them enter a phase where they search, where they're actually paid to go find a company that fits their investment thesis that they can run and then eventually acquire and become the CEO of. So you have this first stage where investors pay them to go find a company to acquire. And then once they find it, they acquire the company and then they grow it. The acquisition, like I said, is partially funded by debt and also with equity. And so this is the traditional search fund model that's been around for 40 years and has generated returns of over 35% net IRR on average per Stanford University. The growth in search funds has been quite amazing, mostly due because Father Time is undefeated. And so the problems are becoming larger and larger. And also the word is getting out, thankfully. Executives are learning about search funds and the opportunities that they provide. And there's just a lot of intrinsic value, but also it pays extremely well. I mean, those returns are very compelling for investors, but also for the entrepreneurs themselves. And so what we see is searchers are getting 1.5 million per year. A lot of that is based off of the sale of the company, but they're in a position where they can revitalize a company and modernize a company and grow it and get value with that, but also with the exit potential and the earning potential. Then also there's been over $2 billion invested in search funds to date, and so it's a pretty large market, but still early, but growing. And this is where we get to search funds are the highest producing asset class in the last 40 years. And that's not me saying that, that's Stanford University. And when you actually compare search funds as an asset class, it does extremely well. It's double private equity and venture capital net of fees. And so these are due to several factors, but it really, in essence, it's going into markets that are underserved and getting into companies that are smaller than traditional private equity. And they do require some heavy lifting. They need to be modernized, and you need to have the right kind of entrepreneurial talent to take those challenges on. And that's where the value comes in. And private equity firms and strategics are actually okay paying the premiums for these companies because they're more updated and up to speed on current best practices and so on and so forth. But really, at the end of the day, the biggest thing to take away from this slide is that search funds yield twice the returns in half the time, which is pretty compelling, in particular because you're not taking anywhere near the same kind of risk and have the volatility as you would in like a venture capital fund, for instance, where half of your investments can go bankrupt. So we're not shooting for 100x with these kinds of investments, but really to focus on 3x in 3 to 5 years all day long for the companies that are invested in with search funds. Why do search funds work? I really like this slide because it really focuses on the balance that you have. I mean, it is a hybrid model where it has parts of venture and also parts of private equity in the same model. And it needs to be a hybrid because of the size of these companies. It's a unique situation where you have to be able to build as well as grow. And so you really need to have a proper balance between the sellers, the investors, and the searchers. The sellers love it because they get to pick their leader. They get to pick the next person that's going to take their company. If they sell to traditional private equity, they don't get that choice. The private equity firm finds the deal first, and then they install their executive and their executive team. But in this model, it's the other way around. And so they have influence. They can work with the entrepreneur to create the growth plan, and to find a proper cultural fit for the entrepreneur. The entrepreneurs love it because they're in a situation where they can work with the seller and get into a company that is already up and running and growing, has a potential for growth, and also investors for the returns. And there's a lot more in particular with this, where there's a lot more symbiotic help with what we're doing. But with the investors, it's a syndicate of investors that traditionally invest in search. So it's not one investor that takes a majority of the investment. And so everybody is kind of forced to work together. And I think that's one of the key reasons as to why you see the results with these companies, but also the obviously translating into returns. There are different search fund models. One is a self-funded search. If I'm a single individual and I just want to buy a company and run it for myself, there's obviously a lot of autonomy involved with that. But typically, these are companies that are in the $250,000 to $1.5 million range, and using SBA loans in the US in order to acquire these companies. So you have more debt, you have less investor involvement, and you're buying smaller companies, but you don't have to have a board, right? You have more autonomy, but you have less upside to these kinds of investments. You have a traditional search where you have a solo search or a partnered search where you're working with a group of individuals to go out and pool investors that are within your network, right? You're pooling people that can invest in the search entity and also in the acquisition. And last but not least, you have the sponsored search, which is private equity backed, and also some search accelerators. The private equity backed search, there are some well-established groups, but there aren't nearly enough in order to fund the opportunity, the $10 trillion opportunity. But it also gives the entrepreneur the opportunity to acquire a larger company and have more sophistication and scale in order to more aggressively grow the company. And as you can see, the trend is increasing capital intensity and more governance complexity, but also a greater return potential. Because the larger the company that you can buy, traditionally the larger opportunity that you have to grow the company. Novastone, that's a partner that I mentioned earlier in the presentation. They've been investing in search funds for like 15 to 20 years ago, and through their vision, they saw that this is a highly fragmented market and figured out a way to scale the search fund and to create it to be more of an asset class. Search funds have been kind of difficult to find and vet because they are so fragmented and different in quality. And so Novastone's goal was to create a program that owns the whole search fund process from start to finish, so that we can achieve scale and efficiency and be that apex partner for entrepreneurs, investors, and sellers. And so far, deployed over 200 million in equity since inception, and have over 40 team members, and have launched 100 entrepreneurs, nearly 100 entrepreneurs since 2020. So how the process works with South Highland Ventures is NCA is the group that built this deal flow machine, right? Where we have nearly 100 searchers that have gone through our selection process, and they are finding the acquisitions. And once they get to a stage where they have an LOI, that's where the institutional investors get involved, and where we get involved to deploy capital into the acquisition stage. So NCA has created this process. It's taken them 7 years to do it. And South Highland Ventures as a partner is helping to run the machine, right? We actually help pick the entrepreneurs into the program, and we're deploying capital into it. And so it's kind of like I'm working with a stacked deck, but I'm also able to pick the cards that are in that stacked deck so that we can focus on the entrepreneurs and opportunities that are of the highest quality. Our allocation, we are basically agnostic. When when you look at the sector, and we are globally oriented. We have companies in the United States and also in Europe. But the key thing is that we're not specifically focused on a particular industry. It's more so the situation that the company is in. And so companies that are, number one, struggling with succession, and also companies that are generally in the 2 million to 10 million EBITDA range, and companies that that have that potential for growth, where they need to be modernized and they've been neglected by the markets, which allows us to get in at an attractive EBITDA multiple, which is typically 4 to 6x EBITDA. That's really where our focus is. And again, this is some of the investment criteria that I've already discussed. But we do lever. It's only 50% debt, which is extremely conservative with most groups, which insulates us more on flexibility of cash flow, but also interest rate fluctuations. A couple of the unique things that we've done with our program is to make it more streamlined and to save time, is that we only work with entrepreneurs that have 20 years of experience in a specific industry. So we're not working with the green MBA students that are in their 20s. Folks that are in the middle of their careers and that have that industry experience and that have already been through a growth cycle with the company. Many of them have grown and sold a company already. And so what that does is it dramatically decreases the volatility of the performance of our companies, but also saves a tremendous amount of time, because usually an entrepreneur needs to like a year to a year and a half to get their feet under them, to really learn and understand the business. And the sellers need to kind of babysit them a little bit to make sure that they're taking care of their baby, right? Their life's work. But with our entrepreneurs, they hit the ground running. They only need like about a month or two to really get a handle on the company. And we're able to achieve results much faster. Also allows us to create exclusive deal flow for companies that aren't on the market. And in many cases, our entrepreneurs are bringing deals to us as we vet them. And that's really one of the key things. Another thing that makes us different, makes us special, is we don't have to lock up a company to buy more time to go raise money for the acquisition. Once we put a term sheet down on a company, we already have the commitments of capital to be able to close. And that gives the seller a lot of confidence in our ability and our sophistication and depth of capital. And so a vast majority of the time, we're working with off-market deal flow, exclusive deal flow. And also, we're not the highest bidder if there are other people that are involved, because it's kind of like a bird in the hand versus two in the bush kind of situation. And people respect our depth of capital and our experience with our entrepreneurs and with our group. Look at some of the numbers. We screen over 4,000, really, we say qualified applicants annually, but it's over 4,000 applicants a year. It's a 2 to 3 month process per cohort, and about 1% make it through. So we're extremely selective in how we pick these executives into our program. We've launched nearly 100 searchers so far, to the point that we're acquiring 4 to 5 companies a quarter. So we're acquiring around 20 companies a year. And so this allows investors to deploy capital twice as fast as a traditional fund would, because all of that upfront work has been done to pre-screen the deal flow. And so we don't have to spend that time looking for the deal flow, because it's already been created for us. Again, working with that stacked deck. We've acquired 23 companies, deployed 200 million in equity, and have 7 LOIs that are currently active. So we have a bench of opportunities that are available. So for more information, here are some websites, and we'll make this presentation available for folks. But I just wanted to make sure that there are some more places where you can go to learn more about search funds and what we're doing in particular, some great podcasts too. But in summary, succession is a global opportunity impacting $1 trillion a year of enterprise value. Search funds are a proven solution for succession. And South Highland Ventures and Novastone have come up with an innovative way where we're taking the search fund model and modernized it for scale to the point where we have generated cash returns of nearly 50% IRR, and our portfolio is tracking at nearly 100% IRR. And more than happy to answer questions if people have them. Thank you so much.
Awesome. Thank you so much for that, Ron. Great
Yeah, no problem.
presentation. Do we have any questions from the audience members at this time? Well, they can't talk, but I hope they would be able to type in here. We have one from Pedro. Does SHV consider investments from different transactions?
Yes, we're an independent fund. We have a partnership with Novastone, and we do have the flexibility to invest in deals that are outside of the program, because I don't want to have blinders on. I want to be able to see what's going on and around the world, and to be a part of that. And so we do have that flexibility. But the key thing is to because of the high quality and the time and the diligence that has been spent on the entrepreneurs and their investment opportunities, that's where we really get to scale. But I didn't want to be chained to only have one place for deal flow. So we do have that flexibility.
Okay, thank you so much for that. There's a follow-up question. How can we reach you to share an investment memo?
Yeah, sure. I think my contact information is still showing on the screen. And that's my cell phone number and my email. We're also having a call actually this Thursday morning at 9:30, where one of our portfolio companies in the program is presenting, and it's actually for an acquisition in Texas. And so if you're interested in that, I can, if you send me an email, I can follow up with you, but also send you an invitation to that presentation also.
Yeah, and another thing is I am going to be opening up our breakout rooms here. So if you want to go ahead and talk to Ron in the breakout room, feel free to. I'm going to go ahead and do that now. Our breakout rooms will be open until about 2:15, and then I will be closing the webinar. So please keep that in mind. Okay, I'm going to go ahead and open all the rooms here.
Okay, I'm going to stop my share here.
Absolutely, go ahead. And you guys can join those rooms.